Hello and welcome to Finance RM. Today we will talk about the different banking products that a bank provides. Firstly, loan and EMI. Loans are the engine of a bank's profits. They are structured financial contracts where you borrow money now and repay later, often over years, with repayment amount exceeding the original sum because of interest. So, how do loans work? When you borrow principal, which is the amount you take, the interest, the cost of borrowing, the fixed or variable rate, the tenure, the duration of repayment, the short term, long term, and decades and months, the repayment method, most commonly through EMIs, security or collateral, assets pledged to secure the loan. Banks earn from interest spread, the difference between the rate they charge you and the rate they pay depositors. Processing fee, one-time upfront charges, usually 0.5 to 3% of the loan amount. Penalties for late payment, early closure in some cases. The types of bank loans. A personal loan is not secured, it's typically 1 to 7 years, and it has a high interest rate of 10 to 25%. It's no collateral, it's a quick approval, and it's very costly if it's risky. A home loan or mortgage is secured as its property. Its typical tenure is 15 to 30 years. It's a low to medium interest of 3 to 8%, and the key features have a tax benefit in some countries, and the risk is that of foreclosure. A car loan is secured as it's a vehicle. A typical tenure is 3 to 7 years. A medium interest range of 5 to 15%. Key features is that vehicle repossession if unpaid, and a risk for a borrower is that if the car loses value faster than the loan is paid. Education loan, it can be secured or unsecured. It's 5 to 15 years in tenure. It's a medium interest of 4 to 12%. The key feature is that it has a grace period after studies, and the risk is that it's job uncertainty risk. A business loan may be secured or unsecured. Its typical tenure is 1 to 10 years. Its interest range is medium to high, from 6 to 18%. Its key features include needs, business plan, and statements, and its risk is that it's business failure risk. An overdraft loan is not secured. Its typical tenure is flexible. The interest rate is high daily, and the key features include it's linked to an account, and the risk is that it's easy to misuse. EMI, equated monthly installments, ensure fixed monthly payments, but interest is front-loaded. The first month, 70 to 80% of EMI goes to interest. In later months, most goes to the principal. So, example, $100,000 loan at 8% per annum for 20 years. The EMI is $836.44 per month approx. So the total repaid will be about $200,745, which is basically double the principal. So smart tip to pay extra early as it maximizes interest savings. Bank tactics in loans include teaser rates, which is lower initial interest then rises, prepayment penalties to discourage early payoff, and bundled insurance as adds cost but protects bank. Next, cards. Cards are bank-controlled payment tools that can be pure spending across access as debit or prepaid or borrowing tools such as credit cards. They are fee and interest goldmines for banks. Debit cards have fund source, which is your account balance, clearing time, immediate or same day, and limits is that it has a daily transaction cap. For fraud protection, money leaves instantly and it's harder to recover. For credit cards, its fund source is a bank's credit line. The billing cycle is 28 to 31 days and a grace period. The interest rate is extremely high at 20 to 45% per annum if unpaid. And the minimum payment trap is paying 5 to 10% leads to years of debt. Rewards, cashback, points, and air miles, and its perks include lounges, insurance coverage, and purchase protection. Prepaid cards load with set amount in advance. It's useful for budgeting or travel, but it's not linked to the main account and it's lower risk if stolen. The key differences is that a debit card owns funds, and it has no interest but rare rewards and a low risk of overspending, and it does not affect your credit score. A credit card has its source of money from a bank credit and the interest if it's unpaid. Its rewards are very common and the risk of overspending is very high. A credit score impact it does have. Prepaid credit cards, the source of money is preloaded funds. The interest is not there. Rewards are sometimes there, and the risk of overspending is low. A credit score impact is not there. Bank revenue from cards. Merchant discount rate is charged to merchants, which is 1 to 3%. Interest on unpaid balances, main profit source. Annual fees, especially for premium cards. A tip: treat credit cards like debit cards. Pay in full monthly to enjoy the perks without the interest. Next, payment and transaction tools. Banks handle trillions in transfers via traditional paper instruments and modern digital systems. Firstly, we have checks, which has the bearer, anyone holding it can cash. Order, only the named person. The post dated, valid only after date, and the cross, that it must go into a bank account. It clearing usually takes 1 to 3 business days, and its risk is that it bounce charges and fraud. A bank draft is prepaid instrument guaranteed by the bank, and it's safer than a personal check. An overdraft is a link to your account. It's interest charged daily on an overdrawn amount. It's common for businesses. Peer-to-peer lending, or P2P lending, is platforms match borrowers and investors, and higher returns for lenders, higher rates for risky borrowers. No deposit insurance means that it's risky. Then bank transfers. NEFT, SEPA, and ACH is batch processed and slower. RTGS and SWIFT is real-time for large sums, and UPI and instant payment is immediate, often free. Credit worthiness and risk products. Banks measure your ability to repay and sell products to reduce risk. The credit score ranges. 800 to 850 is exceptional, 740 to 799 is very good, 670 to 739 is good, 580 to 669 is fair, and 300 to 579 is poor. The factors include your payment history, utilization ratio, age of credit history, credit mix, and inquiries. And the credit score is important as this is what you need to take a loan. If you have a low credit score, you're unlikely to get a loan, or even if you do, it will have a very high interest rate and a low amount. Insurance via banks. Life, which pays your family if you die. Health, which is hospital bills. Loan protection, which pays loans if you can't. And travel, trip cancellations and emergencies. Why banks push insurance? Commission revenue. Reduces default risk on loans. Now, other services. Savings, investment, and other things. So, banks also attract deposits to fund loans. Savings accounts, which have a low interest of 0.5 to 4%. They're highly liquid. Some offer tier interest, higher balance, higher rate. Fixed deposit, which is a lump sum locked for a fixed term. The interest is higher than savings. There's a penalty for early withdrawal. Recurring deposit, monthly deposits at a fixed rate, builds disciplined savings. Investment services, mutual funds, ETFs, bonds. Banks earn commission, not direct profits from investment performance. Safe deposit lockers, annual fee, contents not insured by the bank. And wealth management for high net worth clients, custom portfolio management, and higher fees. Thank you, and don't forget to drop a like on the video and subscribe to the channel. Please do comment any inquiries or any suggestions and advice you have for the channel. Don't forget to be smart, stay smart, and achieve your financial goals.